Hello, myself R. Shilpa, Assistant Professor, Department of BCom BA, PPG College of Arts and Science. Today we are going to discuss depreciation, reserves, and provision, which are very important concepts in the financial accounting. Every business owns fixed assets such as buildings, machinery, furniture, and vehicles. Over time, these assets lose their values because of regular use, aging, and technological changes. This reduction is called as a depreciation. Apart from depreciation, business also sets aside money for the future needs or the expected losses. These amounts are called as reserves and provision. Understanding this concept help us to prepare accurate the financial statement and determine the true profit of a business. Depreciation. Depreciation is a gradual decrease in the value of the fixed asset due to wear and tear, passage of time, or the continuous use. Except the land, almost all the fixed assets lose their value over the time. For example, if a company purchases a machinery for the 5 lakhs, it contains remain worth for the same amount forever. As the machine is used, its value decreases each year. The need of depreciation to determine the true and the fair view of the profit. It also shows the correct value of the asset. It provides the fund for the replacement. It compiles with the accounting principles. Causes of depreciation. The first one is wear and tear, continuous use of the machinery, passage of time. Even if the asset is not used, its value may decrease because of aging. Technology obsolescence. New technology may replace the old machinery, reducing their usefulness and the market value. Accident and the natural deterioration. Fire, flood, corrosion, and other natural causes can reduce the value of the asset. Depletion of the natural resources. Natural resources such as coal mines and oil wells decrease as they are extracted. The basic formula for the depreciation is depreciation equal to cost of assets minus residual value. Methods of depreciation. Business use different methods to calculate the depreciation depending on the types of the asset. The first one is straight line method, second one is written down value method, third one is unit of production method, fourth one is sum of years digit method, annuity method, and the sinking fund method. Almost Almost these methods are used for the depreciation. Among this, the straight line method and the written down value method are commonly used. Method. Straight line method is the simplest method of calculating the depreciation. Under this method, the same amount of depreciation is charged every year throughout the useful of the life. Depreciation is equal to cost of asset minus residual value divided by the useful value. For example, suppose a company purchases a furniture for 1 lakh, the residual value is 10,000 and the useful life is 9,000. The depreciation is calculated as 1 lakh minus 10,000 divided by 9 is equal to 10,000 per year. So the depreciation of the machinery is 10,000 per year. Advantage. Very easy to calculate. Equal depreciation every year. Suitable for building, furniture and the office equipments. Makes annual profit comparison easier. Written down value method. The written down value method is also called as reducing balance method. Calculate the depreciation on the book value of the asset each year. As the book value decreases every year, the depreciation amount also decreases. Formula. Depreciation is equal to book value into fixed asset. Suppose the machinery is cost 2 lakhs and the depreciation is charged 10%. Depreciation is equal to 20,000. The book value is 1 lakh 80,000. So the 10 percentage of 2 lakhs is 20,000. So by Subtracting the 20,000 from the 2 lakh, the book value is 1 lakh 80,000. The advantage reflects the actual value of the asset suitable for the machineries and the vehicles. Higher depreciation is charged in the initial period when the repairs are comparatively low. Meaning and types of reserves. The reserve is a portion of a business profit set aside for the future needs for the unseen. Types of reserve: general reserve, specific reserve, capital reserve, and the revenue reserves. Importance: strengthen the financial position, helps the business for the expansion, meets the future uncertainty, and improves the investor's confidence. Meaning and the features of provision. The provision is an important set aside to meet the known liabilities and the expected losses. For example, provision for bad debts, provision for taxation, provision for warranty expenses. Features: charged against the profit, mandatory according to accounting standards based on the estimated liability, helps the present true financial statement. Difference between the reserves and the provision. Reserve is created from the profit, provision is charged against the profit. Reserve is voluntarily made, provision is mandatory. Reserve is used for the future uncertainty. Provision is also known as known liability. Reserves strengthen the financial position. Provision meets the expected expenses. Thank you.